Good afternoon, everybody. We're going to start here in about 30 more seconds. You all know that we like to start on time, finish on time, so you'll keep coming back. So I appreciate you coming on board. We had a lot of people register for this today. I'm still watching the number count continue to tick up, so I feel like I'm going to get some really good value out of this topic. It was actually my idea. I was batting this idea around with Amy Daniels. So we're going to get started here in a few seconds. Okay, let's get rolling so we can get you on with your lunch and on with your day. I'm Brian Stevens. I'm on the board of the Memphis Chamber, and in my role as a board member, I am the chair of the Small Business Council, and I'm also a Chairman Circle member. And I need to kind of frame that out just quickly because our partner today, Keegan, is also a Chairman Circle member. So these are companies that have really decided to really invest in the chamber, but that investment in the chamber is not about investing in the chamber. It's about investing in the economic community of the whole metro area. So I really appreciate Keegan and Jay Keegan for being a Chairman Circle member and also helping us get some talent today for our presentation. Well, like I said, I'm Brian Stevens, CEO of CASA Public Strategy, where we do complex communication campaigns and try to make it simple enough for people to digest. The first person I've got to thank is iBank. And today we've got, if we can go and get Jeff Kimbrough on the screen. He's one of their vice presidents. I hope I got the title right, Jeff.
Thank you, Brian. That's correct.
I know that you're doing a lot, and I really wanted Jeff to come on. We've had a few other people with iBank come on, and they're a member of the Chairman Circle, also super pro organization. But Jeff, thank you for sponsoring this and giving this free information to the rest of the city and all the members. And as always, anybody that wants to share this information should do it. And we will post this video on the chamber website and e-blast it out so people can take notes and can see it later. But hey, thanks a lot, Jeff. What's going on over there at iBank?
Hey, Brian, everything's going well. Staying busy as best we could. But good afternoon, everyone. Again, I'm Jeff Kimbrough with Independent Bank. And a sponsor, we are grateful that you're all able to join us today. One thing I love about this organization is our ability to serve our clients. And in recent weeks, many business owners have experienced unwanted stress and seeking ways to maintain employees. As a banker, it's extremely important for us to be that resource to help our clients, to put our clients at ease. Responsibility, shared community, these are just some of the things that we care about. These are some of the things that help us serve our clients heroically. So today, we have the pleasure of hearing from Charles and Marty about the Paycheck Protection Program and bringing employees back. And this is a topic that I'm extremely excited to hear about. So again, thank you for joining us. And if any of us at Independent Bank can be a resource to you or your business, let's connect. Thank you.
Hey, I really appreciate your time, Jeff. And I know you guys have been slammed with just how busy everything's been going. So let's get right into the program today. And thanks again to Waddell and Associates for allowing us to have this Zoom platform and their team to help run it. So I really appreciate that. So I got a little freaked out today. So let's go ahead and have Charles pop up on the screen as I introduce him. And I think Marty's on us by phone. So Charles, I came in this morning totally wrapped up because I've been up here in this office for weeks by myself. I've been totally isolated. I've been following other protocols. I was the only one up here. And then today, there were like 15 people showed up. I didn't mean to panic. Luckily, we have a big office, and that's about a third of our team, and they're spread out. So we're still following a lot of protocols, but they've been wanting to get back to work. They've been wanting to get back into a routine. And so when I was thinking about Jay and what Adams and Keegan does, I thought, wow, what a great time to hear from you and Marty on what we asked Jay to do is, can you provide us some real talent to talk about the PPP program and getting the employees back to work, because that's really happening in this area. So I know you're going to fixate on that. And a little caveat is I used to practice law. with Marty. He was one of the first lawyers that I met here in Memphis 1,000 decades ago, and he's your general counsel now. And Charles is the vice president of human capital management. So Jay really gave us two pros. I can't wait. So I'm gonna hush up and let you guys get into it. And I will say, if anyone has any questions, remember, you move your mouse and you'll get a toolbar that will show up down below, and you can hit that little Q&A button. And I will see those, and I will provide those Q&As to Charles and Marty at the end. And people still, for some reason, keep texting me their questions. I think it's a game now that they don't want to use the platform. They just want to harass me. Either way works. If you've got myself, text me. If not, use the platform, wiggle your mouse, and you'll get that Q&A up. And so really appreciate this, and I'll turn it over to you, Charles.
Perfect. Thank you, Brian. Hello to everyone. Go ahead and share my screen, and Brian, you'll let me know if there's any technical issues. So we've also got, as you mentioned, Marty Barton on, and we're happy to support the Chamber as members, and just in general as part of our efforts to get good information out to business operators. What we've done is collect a lot of the questions that all businesses have had over the last few weeks about how do I migrate employees that were otherwise working to get them out of the workforce while my business regroups, and now we're bringing them back. And we're mixing that with the layered approach that is, not only are you trying to get your businesses back up and running, but you're doing it with inside of the confines of the PPP and of course with an eye towards the loan forgiveness provision. So we'd like to kind of walk through what we know are the questions that we keep getting, which let us know where the learning curve is for businesses. And at the end of that, we're happy to take Q&A for as much as is helpful. So again, we want to look at things in terms of the 8-week calculations. It sounds like a simple thing to look at an 8-week period, but there are a lot of moving pieces, things like where are your payroll cycles falling, because that affects your flexibility to maximize the loan amounts. It also has to do with when exactly do you bring people back, how many people are you bringing back, on what compensation level. So there's a whole host of unintended consequences of not thoughtfully planning and working through all of this, not to mention your employee psyche. We know that employers who got this right on the front end are already experiencing a much better experience in terms of employees who were mentally, emotionally prepared to come back to work, whereas companies who didn't do a great job of communicating are now having a hard time getting employees to trust that everything is in good working order. And we have offices where people are just showing up and nobody knows how distancing is supposed to work and any of those other things. So let me first talk about the mechanics of the math of the PPP, and then we'll get into the employee experience of it. Now, it's not new math to say that 8 weeks is 56 days, but we know that a lot of confusion has come from the fact of thinking of this as 8 weeks as opposed to 2 months. And when you layer in exactly where your payroll cycles fit, there's a lot of business questions that are triggered. And I'll let Marty, you want to spend a couple minutes on the cost paid, cost incurred question?
Sure. So Charles is right. The Act itself, the CARES Act, is written such that when you think in terms of the payroll protection loan itself, and how you arrived at that amount of loan really was based upon an employer looking back for a 12-month period. A lot of employers used the 2019 data. Some employers used the 12 months preceding kind of the Act implementation. So maybe April 1 to March 31 of 19 to 20. And so once you figured out kind of your monthly run rate on payroll costs, which is a defined term within the CARES Act, you multiplied that, of course, times 2.5 months, and that arrived at that gave you the number of the amount of PPP loan that you would be eligible for. When I think in terms of the CARES Act and the SBA's PPP loan, I think of it in terms of really 3 visual columns, and that is one we just discussed, like what is the amount of loan that I'm eligible for, And then as a separate matter, I think in terms of how much of that loan would be eligible to be forgiven, and that's a separate calculation. And then finally, where the rubber meets the road is what expenses do I have in that 8-week period that can actually be forgiven and turn that loan into a grant. So what Charles is referring to there in the 8 weeks, 56 days, we've gotten probably half a dozen times we've had this question asked if the 8 weeks is really 2 months or 56 days, because in payroll terms, an extra 3, 4, 5 days, it makes a difference, right? It makes a difference between maybe having an extra weekly payroll or biweekly payroll or maybe even a semi-monthly payroll. And so the best guidance we have is from some examples in the Small Business Administration's interim final rules that were issued sometime about 3 weeks ago, where they discuss, the administration discusses its logic of arriving at why 75% of the Payroll Protection Act PPP loan has to be used for payroll costs and no more than 25% of the loan for other costs. And that was strictly the math of looking at 2.5 months equals approximately 76 days. 8 weeks is 56 days, so 56, 76 is approximately 2/3, three-quarters of 76. And so that's why they arrived at the 75-25 split on payroll costs versus non-payroll related costs. So that's where the 56 days comes into play.
And a point of clarification on that, there's still some meaningful confusion on it. Forgiveness period begins when you receive the money. So there can be a lag between the origination period or the day you actually receive funds. So you have to figure out where your 8-week window starts and ends. And we're going to see in a minute when we talk about how that lines up with payroll. And there's a meaningful difference for employers as you combine that with decisions on when to bring back how many people and what total labor cost. So the other kind of last bit was before we get to the big questions was, your 8-week period. We talked about a June 30th deadline, but your 8-week period could start and end later than that, or at least end later than that, because we know with the new tranche of cash that was approved, those folks are just now getting their money. In fact, many of our clients got their money first week of April, so they're already well down the road, but quite a few of them just got their money last week, which triggers an 8-week period that's going to go beyond June 30th. So,
yeah, Charles, and I think that's a very good point in terms of understanding that certainly with this second tranche of money, and the fact that you very well may have a situation to where the 8 weeks goes beyond the June 30th date mentioned in the CARES Act, so that we expect further guidance to kind of figure out, what that might look like. And I guess, there are even more iterations of CARES Act, 4.0 coming out. So a lot to kind of wade through there. I will say this. A lot of the issues that we see, and quite frankly, there's not clear guidance on, is in the 56 days, there's this cost incurred versus payments made, because you can certainly incur a cost, on a day-by-day basis, but not make the payment until outside of the 8 weeks. Likewise, you may get your money on April the 15th, which is maybe the date of your semi-monthly payroll, but the 14 days leading up to April 15th were not inside the 8-week period. So is it payments made or is it costs incurred? And it's still unclear. I think reasonably, it seems to me more trackable to have a payments made approach. But that's something that, we expected under the CARES Act. We certainly expected guidance by, it said, within 30 days of March 27th. So that would have been April 26th. And we've gotten some guidance, but not what we expected. So we're still waiting, day by day to see if we get further guidance on exactly how the calculus works itself out and what's forgivable.
And we know that a lot of employer anxiety is rooted in the fact that the guidance is coming on a weekly basis now, but it feels like it's a slow drip. Nonetheless, for those who have received the money, there's uncertainty over, well, how much of this is forgivable because I don't yet know because I haven't brought my employees back. It all sort of happened for many faster than they were prepared for. So I want to keep in mind that the loan forgiveness is proportional to your full-time equivalent staff during the covered period, again, covered being the 8 weeks of when you receive the funds. And so you have some input into the math and the planning and your 8-week to or a little bit longer forecasting. Will you be using the average number of full-time employees from February 15th of last year to June of last year, or this year's numbers of January to February? So you've got to look at where are you coming from to know where you're going, right? So we want to look at that because that will ultimately help us understand how important it is to bring back the right number of employees if you are or are not ready, because ultimately you could bring someone back and not put them to work, right? The act is and the provisions are pretty clear that the goal is to get money in the hands of individuals. The employer is just a mechanism to do that for payroll. So you can bring furloughed employees back. They can still be at 0 hours, 0 wages otherwise, but you can pay them their full wages and they're still your FTE. So those are things that we have to weigh. There is one important update, and this was, if you follow the news, even locally in the city of Memphis, there's well-established CPA and law firms that are openly debating this topic. Well, we have some clarification that we got over the weekend about Treasury and the SBA, and Marty, I'll let you kind of talk about what it really means.
Sure. Charles, I want to take a little bit of a step back and just clarify on the FTE count as far as the math goes, is that really nowhere in the CARES Act is full-time equivalent defined. So we kind of have to look at what's the nearest equivalent of that, and that is from the Affordable Care Act or Obamacare defined that term. And so in determining, when you're looking at the math of looking at your full-time equivalents in the covered period, which is that 8-week period after you received your PPP loan disbursement, divided by the full-time equivalent employees during what's called the choice period, which is the 2 dates that Charles mentioned that an employer gets to choose from. The way you calculate that is anyone that averages 30 hours or more a week is put in a full-time pile, and then the equivalent, you determine the equivalent amount of part-timers by aggregating part-timers who worked less than 30 hours a week. You aggregate their hours on let's say a monthly basis. You would aggregate their hours and divide by 120 to arrive at a full-time equivalent number that you would then add to the full-timers to get a total number there. So what Charles is referring to that was issued on Sunday late was this additional kind of FAQ guidance, because there is some, at least initially, there was a conflict, really, I say conflict, within the CARES Act, that where if you had reduced your workforce, either through furlough or layoff, when looking at the math of your covered period, your 8 weeks versus your choice period, there was kind of a, for lack of a better word, a safe harbor or a fail-safe, where that as long as you rehired, and as Charles mentioned, that doesn't necessarily mean put back to work. That means literally have them on your books and pay them. As long as you rehired those individuals and increase and took away any reduction in salary up to 75%, as long as you close the gap on any salary reductions that took place by June the 30th, then any amount of loan forgiveness that was reduced based on that fraction would be the reduction would be taken away and you'd be given the forgiveness back. However, that sounds easy, but with the pandemic unemployment assistance that was kind of built into the CARES Act, where the federal government comes in and subsidizes the state unemployment accounts by $600, you have the situation for many employers out there that for hourly workers making $10, $12, $14, $15 an hour, they could make more money not working, staying at home because of the additional $600 from the federal government than they could coming back to work. So there was this natural conflict within the law where you get grace by hiring someone back, but it's hard to hire someone back when they're making more money not working. So this question kind of addresses that and says if the employer makes that good faith effort to rehire someone, and it says makes a written offer. Now, we don't know what writing means. It could be email, could be a letter, and the borrower or the employer then confirms that they've made that offer and the offer's been rejected, then the amount of the forgiveness will not be reduced. So that kind of addresses the conflict there to help employers out. So that was as of Sunday night.
Yeah, and this matters, and we're going to tie this all in together. The fact that to try to kind of explain it, we've been using the Joe's Hardware example where Joe is a kind of small business owner, has 25 employees. He had 30 under his choice period. So, numerator, denominator, that you need that to be as close to 1-to-1 to maximize your loan forgiveness. So if, for example, as Marty mentioned, we look at the three columns where you start out with what is your maximum eligible debt forgiveness amount of $300,000, that is further reduced by, in this case, the 5-employee deficit that Joe has, which if you kind of look at the right side of the screen and you kind of top down, you net out a $50,000 loss of opportunity for loan forgiveness because he's got 25 over 30 in terms of his employees now for the covered period. So that the practical question for everyone now to ask is, what does Joe do? Does Joe begin to hire employees? Maybe Joe is at 25 employees because he's got 5 who he furloughed and now wants to bring them back, and they say, well, boss, I can't come back. I've got kids at home now, or I'm just not, I'm choosing not to work for personal concerns. We'll deal with that question in a second. But either way, he's at 25. So the clarification Marty just talked about helps us understand that 25, maybe he may be at 26 or 27. If you as the employer can demonstrate that you've made the good faith effort, you've documented that you've engaged in dialogue with his employees, sent them an offer letter or formal email saying that they're welcome to come back and this is what you want them to resume duties, and have them say no. Again, we don't know what it's going to look like for the employer to document this later, but we know that the better records you keep will only help you later. It's also a good time for me to stop and reiterate that the bank is the judge and jury in all of this. So it certainly helps if you have a conversation early and often with your contact at your lender, so that you can understand what documentation they may want to see. We know that loans in excess of $2 million will be automatically audited. Not to say that those below that won't be, but it's still something that we want employers to be prepared for now. So again, that 25 in this case, maybe 25, maybe 27, depending on what particular conditions of the employees are, but it still leaves the practical questions.
Charles, I want to interrupt you and Marty, and then I'll let you guys keep going, because I'm a simple man, and I think everyone can tell why Marty still practices the law, because he's really detailed and he gets the law, and I'm off in other space now, right? Is he gets it? This is a lot of really great information. If you could flip back to that example really quickly. I've gotten a couple of questions, and so I'll kind of dump it in 2 parts. One is, what if you offer the job? Let me make sure I'm getting this right. What if you offer the job back, they don't take it, but you fill it with another person, right? So we've gotten that question before, which is it have to be the exact same individuals, or is it just the exact salary has to match so I can get people that actually maybe want to come back to work? And then the second one is, how do the owner's salaries play as part of the forgivable amount? So you've got the owner's salary, what they're making as part of the potential in forgivable loan. And then the second part is, can you replace them with other employees and you still get the loan forgiveness? And I'll let you answer that.
Hey, Brian, this is Marty. That's a great question. And I will say there has been some conflict in that. There was an article, Charles, was it last week in the Daily Memphian, where there was some disagreement about that question between a CPA firm and a law firm. So from everything that I read, it's not employee specific, not Social Security number specific. It's more positional. And my logic on that is that, again, with the CARES Act itself kind of creating this tug of war between the pandemic unemployment assistance and the PPP loan rehire, it really cuts against an employer's ability to rehire Brian Stevens to come back to work, especially if you're in a restaurant business or if you're in a hotelier. That employee may very well have moved on to another job. They may be on unemployment, the pandemic unemployment assistance. It's just very hard to track down that specific individual employee. So I think logically, just trying to kind of fly high and look at the legislative intent is for the employer to bring back the position to work. And so in my estimation, my best guess is that it's position-based and not specific to the individual person. Charles, would you agree?
I do, and I think we can, going back to the clarification that we offered, we know that SBA and Treasury have declared an intent to clarify that an employee that refuses to come back won't be counted against you for that number. We can, I think, safely, connect some dots that's probably part of the logic of it, is the intent of the law. With restaurants and hotels operate on 100% turnover margin anyway, so it's unrealistic for them to be able to count on their employees for 8 weeks at a time as the exact head count with matching Social Security numbers. So that probably opens the window for you to consider what it would look like if you were to hire people to replace the existing jobs. And Brian, you also kind of asked the question in two parts, which was not only bringing the employees back, the same employees, or bringing new employees to replace them. But if you look at it the same salary, I think that's an open question for debate as well, because in the regular course of business, you would change salaries, merit increases. What if everybody's raises are due in the summer, and that's in May right now, and that's when you've got your PPP money. So if you make changes to compensation, I think arguably that's in the run of business. Now, if you gave everybody a 30% increase, that begins to not look how you would normally operate a business. But I think there's a very open question about hiring new people. Probably yes, as Marty suggested. And if you have to make payroll adjustments, salary increase, I think there's an opening for that as well. So I don't think employers should think of it as hard caps. Now again,
yeah,
I don't get clarification on this.
Right, I would agree with that, Charles. I would say my overall guiding kind of mantra is normal course of business, and I know normal course of business is kind of a sliding scale. We've been asked questions about hazard pay or retention bonuses or anything. You can call it different things. It's like shift differential. And I would say those things can be within the normal course of business as long as it's not exorbitant. You want to be able to, I call it the straight-faced rule. You want to be able to stand in front of an agency or an administrative body and say, based upon the information we had at the time, the guidance, the interim final rules, the act itself, these are the decisions we made, and this is why we made them, and we made them with a straight face. The SBA, Treasury, IRS, they may ultimately disagree with you, but if you did so in good faith, then it's a big step toward avoiding fraud, of course, and avoiding penalties because you made a reasonable, good faith decision. So hopefully, it is my sincere hope that we get more guidance from SBA and Treasury, and as Charles mentioned, that is leaking out day by day. So I encourage employers to. I have the DOL, the SBA, Treasury. I have all of these FAQ websites up all the time, and I'm constantly F5ing to get them to refresh to see if there's anything updated, just to give us the most bleeding edge information we can have for clients.
So I think, Brian, the questions you brought up and you presumably just got are the same ones we have on the screen that we've been getting. We do want to kind of caution as you think about adding and replacing those existing jobs. We know that business owners may have multiple locations of the same type of establishment. And so moving employees around, if you've got different loans for different business entities, It may be possible to reallocate some of the staff if they do perform work for one or both, but that's something that is still, it is most likely an option, but one we have to walk through very carefully. And then lastly, if in Joe's hardware example, he can get to 25, maybe he can get to 28, but not get to the full 30. Back to that 1-to-1 ratio. What do you do with this big bag of cash? Do you just walk up to the bank and give it right back to them? Arguably, yes. If not, remember the original point of all of this, it is an SBA loan. The loan forgiveness is just one feature of it, but it becomes one of the most attractive short-term bridge loans you'll ever have. So employers need to plan for those monies not being used for payroll, because those restrictions are then lifted, because now it's an operations business loan for you to do with whatever you would normally do with a loan. So all of these things affect the math in the next few weeks and next few months for employers.
Yeah, and I would say that, employers have to be kind of flexible here. I mean, because we're still waiting on the guidance between the payments that you make versus the costs that you incur. I mean, as an employer, you incur daily payroll costs, right? I mean, even though you have a biweekly payroll, each day costs you something. And so I think it's important to, as Charles mentioned, kind of have an open dialogue with the lender, with your bank, to know exactly. A lot of banks I'm starting to see are putting out initial guidance. They're caveating that with the same as we are, saying that based on the guidance we have now, here's what we're going to need to see. Obviously, payroll data is important. And from what I'm seeing now from the banks that I've seen, that clients have forwarded me, they're looking at dollars spent, so it's more of a payments made approach. So needing to be able to document the payroll, needing to be able to document the rents you pay or the mortgage interest you have, the utilities, and utilities is broad. We still don't really have a clear definition of what that means. Does it mean common area maintenance type charges in your lease? Probably, but we're waiting on guidance on that. So just gathering those documents to be able to give to your lender at the end of the 8 weeks will certainly help. And also, I will say one of the things that we forget about in all of this is that if you get a PPP loan, there are other parts of the CARES Act that you can't avail yourself of, one of which is the employee retention tax credit. You can't have both a loan and the employee retention tax credit. You can defer your OASDI, which is really your employer part of your Social Security taxes. You can defer them and have a PPP loan, but once the loan itself has been forgiven by the bank, then if you are deferring those Social Security, the employer side of Social Security taxes, you have to stop the deferring of that once the loan is forgiven. So things to keep in mind if, as an employer, you have multiple of these things running at one time. So.
Skipping ahead, if still time permits, Brian, wanted to handle the other half of all of this, which is in a hurry to get employees back, replacing them, and get businesses up and running for those who are able to. There's kind of a set of questions that have really popped up that are sensitive, which is, I've got these live bodies in my building. What do I do with them? And the questions first started with, well, what am I legally obligated to do or be as an employer? And it starts with that duty to warn. If you are aware, we just had a client this morning. It's a warehouse environment that had 2 employees that were on the floor that tested positive, and they made their way onto the factory floor and talked and interacted with a whole host of people. Well, they went ahead and shut down the entire factory and sent everybody home for an indefinite period of time, and they'll regroup. So as long as the employer is notifying individuals of the risk and the exposure, it's unclear what they're obligated to do per OSHA or any other regulations. But if you're dealing in good faith and telling your employees that we have a situation, I think that will go a long way towards covering all of your employer responsibilities. In terms of PPE and social distancing, you want to do those things, but again, there's really not a lot of hard and fast regulation on what you are obligated to do. We've had the question, are you supposed to have a bucket of masks at the front door? And while the city of Memphis, for example, is strongly urging essential businesses to do that, it's not a realistic It's not a realistic deliverable for many employers. You couldn't go get 100 masks if you wanted to in many cases. So you just have to do what you can and demonstrate that effort.
Right, and I would say also to that, I mean, the city of Memphis and the various municipalities, and even Charles is in Atlanta, and what Governor Kemp is doing there. I mean, a lot of them, they're leaning heavily on OSHA's existing standards, and OSHA has this kind of hierarchy of very high risk, medium risk, low risk, and so when you look at their guidance, most businesses, believe it or not, would be in the obviously low to medium risk, where masks are certainly not required, and it can be, if the employee, wants a mask, then of course employers can make them available. So I think it's really going to vary business by business as to where on that scale an employer falls, whether they're very high risk. It all has to do with the level of activity with the public, and maybe even with the public that has or is predisposed to exposure to COVID-19. So most businesses would not fall into that, but something to keep an eye on and to take a quick read. It's not very long.
And while there's 100 different questions that we continue to receive on all of these what ifs, there's a couple that we feel are important that aren't being asked just yet, and that is in terms of offering and rescinding employment. You want to carefully plan for employees in the event that you had laid them off and you want to rehire them as an employee, as opposed to employees that were on what we kind of have accepted calling a furlough, and are reinstating them. Those are two different things, and they may be two different things for benefits participation. The expectations of the employees vary. There's also something to be said for if you make an offer, going back to the Joe's Hardware example, he needs to bring employees back quickly. An employee says, well, you furloughed me, I'm your employee, but I'm not willing to come back to work. Well, in that case, you can rehire someone new, under that logic, and put them to work. And the other employee essentially is become a voluntary termination. You can make an offer and the person refuses that offer, or you can rescind the offer if they're not immediately available for work. And those are things that employers have to think about and be thoughtful in how they communicate what they're doing, why they're doing it, because employees obviously care about how you view the relationship tangibly in terms of compensation, in terms of safety, in terms of benefits eligibility. So we want to make sure that employers are focusing on that. And then lastly,
go ahead, Charles. I'm sorry. Go ahead.
And then kind of the last part of that is the big what ifs. And there's the other one in particular that we want to talk about is, what do we tell our employees? If you have an employee who tells you as the employer that they've tested positive, you still have an obligation to inform other employees that they may have been at risk, but that doesn't mean that you run a contact tracing exercise on paper in front of your workforce. So you don't tell your employees who it is. People can figure it out, because if there's 7 of you in an office and one person's not there, people will deduce that, but that's okay, let them do that. You don't want to go discussing anyone else's medical information. Personal privacy, confidentiality still applies, and you are responsible for that as an employer. So no good deed goes unpunished. If we want to tell coworkers about a fellow coworker that we care about that is home under quarantine or maybe seriously ill, it's not something that you as the employer get to just talk about.
No, I think that's a good point. I think the HIPAA laws still apply. I think all of the alphabet soup of Title VII laws and the ADA apply. So you still want to be mindful of that, and keep your ears open for all sorts of things, from kind of an interactive dialogue between the employee and the employer about reasonable accommodations based on this, and HIPAA protected health information, while also balancing the safety of those that remain at work. So I think those are all very valid points.
Hey guys, I've got a series of questions that I want to get to, and I know that you guys have got, it's funny when we got on this call, they could go for 90 minutes and provide a ton of value. But I asked them to limit this so we could get really into the meat of this if we start to have questions. And I've got a lot of questions flying at me left and right. So do you mind if I interrupt you right now and start kind of doing a rapid fire Q&A period with you?
Yeah.
Sure. Okay, great. So just to kind of explain it, I'll kind of ask, and if the answers are quick. And if you don't know because we don't have enough information out, I think that's a really acceptable answer right now as all these things go on and on. So I think you say, we don't know yet. And I think everyone will know that we'll try to get back in touch with them. So the first thing is the employer, the owner of a business, are they calculating this? Or are there certain caps about just the employer and the forgivable part if you have partners and things that work in the company?
Yeah, well, I think, this is Marty, I think if you look at the actual definition of payroll costs within the CARES Act itself, I mean, it lists out, of course, the sum of payments and any compensation with respect to employees. It goes through all that, but there is a part of that definition that also says the sum of payments of any compensation to or income of a sole proprietor. Then it gets into the concept of income, net earnings from self-employment. So I think, you as a business owner, if you are, it depends on your corporate form, and I don't want to get too far in the weeds. If you're a C corporation, you can be a W-2 employee of your own business. But if you're a member of an LLC, then you're not a W-2 employee. You can take a draw, but you receive what's the tax form is a K-1, which is earned income from self-employment, which is the language that's in the Act. So if you're an active owner in the business, then I believe that what you pay yourself as a draw and earn as a K-1 earnings from self-employment, or if you're an owner in the business and you are a C Corp and so you are paying yourself as a W-2 employee, those payroll costs would be allowed. Of course, all the payroll costs like that are capped at $100,000 annually, or I think it's $8,333.33 on a monthly basis. So you're limited by, an employer that makes a lot of money is going to be limited in what they can claim as a payroll cost under the PPP Act.
Okay, so Marty, that kind of leads me to the next question about, I don't know, Charles, if there's a slide that just kind of lists this. If not, I'd like to hear what all is considered in the forgivable amount. Salaries up to 100K, health insurance, rent, payroll, taxes, the taxes. Like, do you guys have a list that you can throw at us?
We don't have a list today, but we can talk about those. The primary is the payroll costs. That can include commissions, bonuses, all of those things for your direct employees. The unasked part B of your first question, though, Brian, is what about 1099s? And those are not covered. Those are different than your K-1s, your business owners. So paying your contractors is not a payroll cost. That's a separate business expense. So you can't put, in many cases, we've had people ask us, can I put my husband or wife and the kids on the payroll to make up for it? Now that's a no. So,
yeah, and there was some confusion early on in the actual language of the Act, but it seems clear afterwards in the guidance that these 1099s themselves can actually go out as sole proprietors or 1099s and get these PPP loans themselves. And so the legislature is very concerned about double dipping. I do believe, obviously, as far as the amount that you can use to have forgiven in your loan is the payroll cost, right? Which includes health care payments, retirement payments like matches that an employer would make, things that we talked about with your rent, your utilities, your interest on your mortgage, and then there's this catch-all of interest on other obligations that aren't. We really don't know what that means. All of these kind of whittle the loan amount down to hopefully move further and further toward it being a grant. But yes, we can certainly put together that list and distribute it so that you all can circulate that later.
So Marty, what about payroll taxes? The employer share of the payroll taxes included in the forgivable amount, not included?
That gets complicated because if you recall, so not only is there the CARES Act, but there's the FFCRA that talks about the emergency paid sick leave and the enhanced FMLA, and if an employer is paying those, they get credits against their employer, against the cost. And so you have that, then you have those people that are deferring, also getting the loan, but that are deferring their taxes. So generally speaking, the way the law reads is that, and there was some clarification on this, is that payroll costs can include kind of the state and local taxes, but they're not going to include the federal taxes, the 940 to 941. I think it's off the top of my head, I can't remember, but it's basically section like 21, 22, and 24 in the IRC, but it's the taxes between February 15th of this year and June 30th the federal employer-related taxes in that period because they don't want there to be any double dipping. It seems to me that as a part of the overall cost, that's going to be kind of pulled out.
So I'm getting several questions. I'm trying to kind of compact them for us for time's sake. Is that some companies are in like this phase 2 and they're not going back to work yet. And so how does that work if they don't actually bring their employees back for some period of time? And then they start bringing it back. So is it deferred? Is their loan basically deferred until they get going again? How does that work?
Well, I mean, there's nothing in the act that says that. I mean, it's you basically have to spend the money in the 8 weeks after you get the loan. That is a frustrating part. It's especially frustrating for employers that are more seasonal, that maybe they have more business in the summer, and so their business isn't up and running, or perhaps they're in phase 2 or phase 3, and so they're not allowed to open. So the guidance that everything we know just says that you have to use the money and they have to be back on your books by June the 30th. Again, we know this is going to change because we know that this second tranche will certainly have 8-week periods getting past June the 30th. So we're still waiting on that. But from everything we know now, having the ability for them to actually do work is secondary to them actually just being paid.
Yeah.
And being rehired.
Marty and Charles, what I'm hearing a lot of is you guys are really focused. You're paying attention. You're still waiting on the government to catch up. So what we might want to do is have you back in a few weeks, and I'll let Jay Keegan kind of let me know, like, oh wow, we've got a lot more information, and we can have you back on to try to get into the meat on some of these things, because I think a lot of people might find this valuable, because I'm even getting questions about how long until we have to provide the documentation, and questions about what's considered in the utilities. And I know that this isn't covered, like cell phone, internet, all these things. And I would say everyone probably needs to just keep good records of everything. And then we'll keep kind of cutting through this a little bit more. What's your advice right now with so much unknown, Charles?
Yeah. I think that's a great question. So my advice is just that, to keep your records, keep your payroll records, keep your utility records, all of but you normally keep up with health care payments made by the employer, with retirement payments. And we are in wait and see. And so, I would agree. It seems like to me, I would hope sooner rather than later we're going to get this guidance. But for right now, a lot of the questions we get are just gut feelings for us. There's nothing we can plant a flag in and say this is the answer. So I think you are in wait and see mode, but it never hurts to be prepared and to keep your documentation, because 8 weeks after, sometime within 9-10 weeks after your loan, the lender's going to start asking for documentation to figure out what's forgiven and what's not.
And to add to that, I know it feels like the question you asked is like we're in this Brewster's Millions type scenario where you've just got to burn through this money. But the other thing is you don't necessarily need to be paying it right now. You can wait until the end and make those catch-up payments, right? And you don't have to you want to keep your regular payroll cycles, or you don't want to, or in the reverse, you don't want to go making weird out of cycle or change your payroll cycles, but you can pay higher amounts later on regular payroll cycles, for example. So
it doesn't really matter, Charles, if you decide to bring somebody back at 90% of their, right? You just get 90% reimbursed, but you can stretch it out a little longer.
Right, 8 weeks, right? It's what you do at any point. Right, how much money's on the table at the end of the 8 weeks?
All right, so and one question, then I want to kind of re-summarize this for everyone is, you've got this, what if somebody refuses to come back to work because of personal fears? And I will call it, I'm going to get in trouble when I say this, snowflake-itis. That's terrible because people are actually being injured and hurt. But like these fears, I don't like the word fear because I don't know if it's real or not real, but what do you do if somebody doesn't want to come back?
Yeah, that's an interesting point. We're seeing that. We manage state unemployment tax accounts for our clients as a PEO. So we're knee deep in conversations and correspondence with the states to see what they're doing and how they're treating it. Every state's a little bit different, but overwhelmingly, especially Tennessee specifically, once there is work available, and you've made the work available to the employee, and we're past the ability whether it's telework or not. If the same job can be done via telework, the strongest argument is let them conduct that work through telework. But if we're talking about a physical environment, or a store front, or a factory floor, if once the work is available and the individual is either accepting or not accepting the work, it's a can't or a won't issue. If we can eliminate the can't via personal illness or childcare, and they're saying, and they're, articulating to you that I just don't trust my coworkers, or I think the world is going to end, or whatever kind of degree of concern the individuals have, they're refusing work. And that means the employer can then report them, and that sounds terrible, but the employer can report them, and they would, in theory, be ineligible for unemployment benefits. Now, the state may still say, get their version of things and find a wrinkle to allow it. But in theory, once an employee refuses available work, they are ineligible for unemployment benefits. And if they're ineligible for the state benefit, they also become ineligible for the $600 federal unemployment amount.
Okay, so I've run a little bit longer than we normally like, but that's why we always have a little buffer zone in this. And I'm capturing a lot of these questions for later. I basically kind of want to get into it with you guys later on with some more real world examples as we bake the facts out. But I would say that what I've heard is you got 8 weeks to burn up this money. And whether or not you defer payments or don't, you need to burn it up in 8 weeks. And you need to try to write down and keep track of, just like you would in accounting, keep track of everything. Sit down with your banker and see if they're going to kind of take some things off. I would go to the bank with everything and have them kind of say, no, we're not going to allow you to take your, you're over $100,000 in payroll, so we're going to cut that out. You're at 90% salaries on this stuff, so you get that, but you didn't pay any payroll taxes, so you don't get credit for that during this 8-week period. So you really need to kind of use what you normally use, is what kind of keep your normal payroll cycles. It's not a windfall, but hopefully you can capture as much as it back as you can. And if you can't, it's still a really cheap loan that you can pay back. Can you pay it back immediately so you don't ever get any interest on it?
Yeah, I've not seen anything in the law that has any kind of prepayment penalty. So
Okay.
In theory, I think you could.
So you might end up, taking out, let's say, $100,000 loan and finding out you get 80,000 of it covered by hornswogging with your bank, and you got to repay 20 of it as a low interest loan. So I would keep these reserved until after this 8-week period wraps up and we got a lot more detail, right? So don't go to Vegas. It's closed anyway, right? Don't go to Disney World with the money.
Right.
Be cautious until you get kind of this wrap up.
That's right. That's exactly right.
Okay.
I think it's fair to spreadsheet it all, track all your expenses, track all your costs, meet with your banker, and then wait for guidance. I mean, there is a possibility, they don't hold me to this, but there's a possibility with a lot of the kind of clamoring going on with this second tranche that perhaps there may be some standards loosened on the 8 weeks, because there are a lot of employers that don't spend the money until the summer because they're more seasonal. And so, more to come.
Yeah, and if you guys seen any, they have these loan forgiveness calculators and all that.
Yeah.
Has any government entity put like a calculator where you can go put all this stuff in and see what it is? Is that available anywhere yet?
TurboTax hasn't gotten around to that yet.
All right. If you guys get that, will you please let Amy Daniels know so that we can
Sure.
push that out to the world? If there's a way to, some simple, app that tells you how to do this, that would be really valuable to us. So
Absolutely.
I'm going to wrap up today. I really thank you. I'm so sorry I couldn't get to all the questions. Some of them I know you don't have answers for yet, so I'm going to write this down afterwards and try to play around with it. Do you have something going on this Friday? I see every Friday at 10 a.m. Charles, that you want to promote real quick?
We do. It's a good, kind of cutting across some of the similar content. We take all of the questions that we gather from a week-to-week basis, so we know that's timely to employers, and we do something very similar to this every Friday. So there's just, as long as there's an appetite for it and people need information, we'll offer what we have.
Well, I think there's an appetite. So go to adamskeegan.com. There's their phone number, and the chamber will send this out. So if you participate, they're recording it, so you'll have this link. But go to adamskeegan.com and they can answer even more of these questions. And I think we'll probably, I know Amy Daniels is listening. I think we'll come back to this at some point and really try to have just a rapid fire Q&A session with you guys. I really appreciate it. So for all you Lunch in the Know participants, thanks to iBank for sponsoring this, and of course Adams and Keegan for allowing us to have some experts. Thursday, we're going to have a talk about the county budget and the impact on the county government, how it may impact your business. That'll be really interesting. I think we got Billingsley, the chair, to join us. So that'll be that'll be a lot of fun. So that's same bat time, same bat channel, noon on Thursday. And then after this, I think we're just going to go to Thursdays. So keep that Thursday time blocked in and let me know, or Amy, if you've got any topics that you really want us to cover, or if you want us to get right back into this. We had a lot of great questions. So thanks everybody for joining us. I'm going to give you 5 minutes to do whatever you want to. Really appreciate it. And as always, send us some feedback on what you want in the future. Really appreciate it. Thank you.
Thanks, Brian.
Thanks, Brian.